Budget 2023, the fine print.
Hello and welcome to this special conversation. We are calling it Budget 2023, the fine print. I'm Surabhi Upadhyay, and over the next half an hour, we will be joined by a panel of experts to decode and simplify what the budget has meant for the BFSI sector, banking and financial services. That's what we are going to focus on. Let me quickly introduce our guests on the panel today. We have with us Sunil Badala, partner and head of BFSI tax at KPMG India. We also have with us Dipesh Shah, Executive Director of the IFSC Authority. We have Amit Patwardhan joining in, Head of Tax India at HSBC India, and Tarun Rustagi, CFO at Canara HSBC Life. Gentlemen, thank you so much for joining in. And Sunil, I have to open it up with you because the biggest headline for the BFSI space really was the hit that came in for insurance companies with, these non-ULIP, non-term policies getting the tax heat. So was that really the big headline for you as well? Or is there something else that you're focusing on?
No, I think it's pretty much what people have been talking about. So this is obviously in relation to the high premium policies. So effectively what will happen is effective 1 April 2023, if you have paid the premium in excess of 5 lakh rupees a year, then the entire proceeds on those policies are actually not going to be exempt in the hands of the policyholders. And that is actually creating a big hue and cry in the insurance industry. Obviously, I mean, what will happen is that the CBDT will come up with a computation mechanism in terms of how this is going to be taxed going forward. But it looks like that whatever premium that you pay will get deducted from the final proceeds that you receive, and the balance amount will be subject to tax. And also, if you have claimed deduction under Section 80C, which is available when you pay an insurance premium to the extent of 1.5 lakh rupees per year, then whatever deduction that you claim, that also will get added to your income. So obviously, it's a huge negative for insurance sector.
Oh God, that's a new one. That at the time of the payout, the deduction under 80C will also get clubbed along with the income. Let me bring in Mr. Rustagi on this. What's your read through? As Sunil also mentioned, that I think we're still awaiting the fine points on this in terms of the computation, in terms of whether it is sort of if it's across multiple policies, then how is tax paid out? But your interpretation and some first thoughts around this.
So what's going to happen is it's the first phase was introduced in 2021 budget when unit-linked policies were capped at 2.5 lakh rupees. So in this budget, non-unit-linked policies are now capped at 5 lakh rupees. So like any premium which you pay, it can be combination of one policy or multiple policies at a client level. So if your premium is exceeding 5 lakh rupees, then the proceed for that policy will be taxed. And the double impact is, it will be taxed under income from other sources, which will be your normal, the slab will be applicable. So it will have some impact on such kind of policies and such kind of premium or business you're getting. And also the benefit for the policyholder will go away. So they'll have to pay tax on that.
Tarun, one interpretation was that maybe the focus is more on the high income earners who are using some of these products and paying chunky premiums to make their investments a bit more tax efficient. Do you agree with that? Or is it going to impact everybody? I mean, I could have 15 different policies with the small premium amounts, but when you add all of them up, I could be triggering this 5 lakh threshold. So how will I be impacted?
So everyone will get impacted if your total premium outlay is more than 5 lakh rupees, other than non-unit link. You will get impacted. Other than term insurance, because in term insurance, the death benefits are all, it's still allowed or exempt. So even if, let's say you have 2 policies or 3 policies and term insurance, you're paying 50,000 rupees and other 2 policies are actually up to 5 lakh rupees. So you can very well say that this 50,000 rupees policy is exempted. We need to get more fine prints and clarification. So anyway, that will get excluded. But the other 5 lakh rupees policies will get taxed under this new section or new amendment. and definitely there will be some section who are using for tax saving purpose, but there is a significant portion or section which are using insurance product for as a saving, for saving, for accumulating the wealth, and that will definitely get impacted. So the tax benefit which used to have the insurance product used to have will go away.
Sure, sure. And of course, we await more details to figure out exactly how the taxation on these policies will work now. But Sunil, just to come back to some other products, I've been hearing a lot about these MLDs, market-linked debentures, because taxation now has changed, I believe. Now it'll be taxed as short-term capital gains. Is this a very disruptive move?
Currently, what's happening is that depending upon your period of holding, you classify them as long-term capital asset or short-term capital asset. And obviously, when you classify this as a long-term capital asset, after holding it for more than 12 months, you pay a concessional rate of tax, correct? Now, what's going to happen is that all of these MLDs will be classified as a short-term capital asset, regardless of the period of holding, which means it's going to be taxed at the rate applicable to short-term capital gains tax, which is obviously much higher than the long-term capital gains. And obviously the justification or the rationale given was that these instruments are more in the nature of derivative products, and therefore they need to be taxed at a higher rate.
Okay, that's a big one, right? Because the holding period doesn't matter. You could hold it for 3 months or 3 years or 10 years, but it gets taxed at 15%, which is the prevailing short-term rate, right?
So that's going forward, yeah. Going forward, holding period does not matter. But what I was saying was that if you are holding it for more than 12 months, it will be long-term capital gains, and therefore you will pay a concessional rate of tax.
Yes, that was the regime prevailing, up until FY23. That's one. Sunil, also just help us understand how taxation is changing for REITs and InvITs, and whether that's going to be a little bit of a blow even for these products. Will end investors have to pay more tax?
Yes, absolutely. So again, REIT and InvIT, if you look at broadly, there are 3 streams of income which get distributed on a regular basis. So dividend, interest, and in the context of REIT, of course, rental income. And over and above that, there's a repayment of debt that takes place. Okay. Now, what was happening was that whenever there was a repayment of debt that happened, some of the investors did not reduce those repayments of debts from the cost of units that they paid to acquire. Okay, which meant that they did not pay any tax at the time of receiving the debt repayment, and also they did not reduce from the cost of units. So that tantamount to obviously double deduction. So in order to plug that loophole, the government has amended or is proposing to amend to say that if there is any repayment of debt is taking place, that also will be subject to tax in the hands of the investors. The only exception to this rule is that if there is a redemption of the units fully or partially, then to that extent there will be no tax. So I think whenever a repayment of debt takes place from the REIT or InvIT, they would have to, I think, classify this as a redemption of units. Otherwise, this is going to be potentially taxed in the hands of the unit holders.
Okay, let me also bring in Amit Patwardhan into the conversation. Specifically on this point, Amit, would you like to add anything here? And in your opinion, is this going to make this this class of sort of products, REITs as well as InvITs, a little unattractive?
So I think for REITs and InvITs, there have been specific taxation in respect of that being tax transparent. And there was always an ambiguity on this particular point on how the repayment would be taxed, and different positions were taken. So in this case, at least there's a clarity, though it's not exactly favorable, but there's a clarity in terms of how the repayments would be taxed. So that would end all any uncertainty which was there in respect of the tax. That would be my take.
So we've discussed some of the major parts of BFSI, different categories where we had announcements, and all of them seem to be, well, if I could say, marginally negative, whether it's MLDs or insurance or REITs. So now let's move to some positive news, and the positive news definitely came in for the IFSC, for GIFT City. So let me quickly take it to Dipesh, Shah. Mr. Shah, do tell us. I think this is the one, silver lining or the bright sparkle in terms of announcements for the BFSI space, right? So tell us what makes you the happiest.
There has been quite a number of announcements which have been made both from a tax and a non-tax perspective. It really brings the International Financial Services Center at par with the other financial centers from three perspectives. One, as I said, from an ease of doing business, that a lot of approvals are required for the new unit to get started in a financial center. So what the budget now does is that it brings all the approval to a unified regulator, International Financial Services Center Authority. So when you come and set up a new unit, whether you are from an Indian zone or you come from an outside zone, the IFSC authority will be the coordinating authority for all your approvals, whether you need a NOC from the domestic regulators or approval from the for the IFSC business is all placed at one place now. Two, I think very importantly, the IFSC, the objective of the International Financial Services Center has been how do we onshore the offshore financial services? And there has been clearly two very important announcements there. One from the perspective of, allowing the Indian institutions, banks particularly, to do acquisition financing. Now, this is a business where when the Indian corporates were, acquiring assets outside, you will normally have an offshore bank helping you. But now with this announcement, the Indian banks and the IFSC banking units, particularly the foreign banks, will be able to contribute and provide the structures for the Indian corporates to acquire assets outside. And second, I think I'm sure your channel does a lot of work on the capital market side. The overseas derivative instruments is been also been now recognized under the SCRA for the IFSC zone, which is again going to be a huge enabler to onshore this business which is sitting in the offshore financial centers.
Okay, very quickly, I mean, if I could get some further inroads on these two aspects, both are very critical. First on ODIs, Dipesh. Now, we moved from a regime where the regulator kind of was painting ODIs with a black brush, if I could say that, to now making it regulated and allowing GIFT City IFSC to issue these instruments. Do you think there will be takers? What kind of volumes would you expect, and how do you expect the international community to receive this?
Yeah, I think what we should look at this from a perspective as from an international business, how this has been done. So if we really see from the domestic perspective and from an IFSC perspective, obviously they both have a similar objective. It's not that the objective are different. The objective for the IFSC is that if a business is done from, say, for example, the ODI business is done from France, Singapore or Mauritius, how do we also try and structure this, which is in a way, in a regulated way, but structured way from an IFSC zone, which obviously meets the requirements of the domestic regulator also. So it's not that when you are, allowing these structures, it is going to be on a standalone, sitting on a standalone basis, but it will obviously meet the requirements from all the corners. And we do believe that there is a lot of business potential, which has gone to France, Singapore, and Mauritius in particularly, because from a tax perspective, that becomes much more efficient. Now, with the IFSC SCRA been amended to allow the ODIs to happen from the IFSC, is going to be a big enabler for the structures to be done from the IFSC zone.
Okay, we'll talk a little more about this acquisition financing that's been opened up as well. But before we do that, we do have to take a very quick break. We'll be back in just a moment.
18 present Budget 2023, the fine print.
Welcome back. You are with this special. We're calling it the Budget 2023 Fine Print, and we're with a panel of experts to decode what this budget means for the BFSI sector. We've discussed, of course, a lot of announcements, including insurance, including MLDs, InvITs, and what GIFT City has had in store. But let's go back to an issue which, of course, impacts a lot of people in the financial landscape, and that is the withholding tax on dollar loans, basically the interest that is to be paid on dollar loans. So for this, I'm going to come to you, Amit. Explain to us what changes, if anything at all. I think the rate of interest was at 5%. What happens now?
So the rate of interest under 194 LC and LD, which is for dollar loans and interest for the foreign portfolio investors respectively, now goes away from 30th of June 23 and is now at 20% under domestic law. So for the dollar loans, it should not be looked at as a tax rate for the foreign lenders, because typically all these contracts are on a gross up basis. So it's the Indian borrower who bears the cost. So considering that, if the cost goes up, even under the standard treaty, the minimum rate is 10 to 15%. Then the tax gross up cost is actually going to go up for the Indian borrowers. So it's actually the additional cost of borrowing for things such as capital outlay, because these are all term loans. So that's for the 194 LC. So far as LD is concerned, which is the interest rate for foreign portfolio investors, they usually assess the yield on a net of tax basis. So in a rising interest rate scenario, it's going to be the lower yield from the Indian securities as well as the corporate bonds. So my take would be that we still need more time to get through the new regime. So this needs to be extended for another 3 years till the global economic stress as well as the rising interest rate environment settles down. Otherwise, it's going to increase the cost for the Indian corporates.
So now that the provision has not been extended, at least there's no such announcement, what will the rates be, the prevailing rates?
So the domestic tax law rate goes up to 20% from 5%. Wherever the lenders have tax treaties, depending upon the treaties they have, the rate may be 10 or 15%. And then there'll be a lot of documentation, particularly for the dollar bonds, for example, issued by the Indian companies. So administrative compliance for the Indian companies and the lenders is also substantially going to go up.
Okay, sure. Amit, just one more point on TCS and TDS provisions. I think there was a big ask that the multiple rates that we have, tax collected at source or deducted at source, there should be some harmonization, some rationalization. With respect to the financial services industry, is there anything there?
Yeah, so we were expecting some rate rationalization because government has made it clear that they want TDS or TCS as their tracking mechanism, and there's no taking away from that. But what the industry wants is a harmonious, unambiguous, specific TDS regime where we know on what amount we have to deduct tax, and maybe moderate one or two rates which could be applied. That will ease the compliance burden. That will also ease the ease of doing business. And that will ensure that the compliance is not left to anybody's interpretation. So what our ask from the government is that we need a simple regime and few rates. So no running away from compliance. We want to comply, but please simplify it for us from a ease of doing business perspective.
Gentlemen, we're coming down to final thoughts then. So let's take a sort of quick, last words from all the panelists. Tarun, let me come to you. We've, of course, discussed the insurance hit. That's the big negative. Anything else that stood out for you in the budget?
So there is only one positive on PMJJBY. The stamp duty is waived off. So that is something which will become this product more sellable from the insurer perspective. But also, apart from this 5 lakh cap, we are moving, pushing or, targeting that more and more people move towards new tax regime, which means all your ATC deductions, etc., will not be available to the taxpayer. And in ATC, people used to buy insurance, to save tax. Now, if there is no kind of requirement, it will definitely have some impact on insurance business. So that is also seen, and India is really underpenetrated on insurance. There was some need for from the government side or regulator side that we should push more and more insurance benefit to the people. But I think that is also moving away that kind of a benefit from the people, right? And they will not be, I will say, not looking at insurance as one of the product on which they can save tax.
Sure. Sunil, some thoughts from you beyond some of the products that we've discussed where there is adverse tax impact. If you were to sum it up for the BFSI space, then what does Budget 2023 have in store?
I will say a big positive for IFSC, which we have already discussed, largely positive for NBFCs. Of course, we could not discuss some of the things that have happened, negative for insurance. But I think what really stood out for me is, financial services been identified as one of the 7 priorities of the government. So I think it's just the beginning, and we are going to see a lot more activities in the coming year.
Okay, you mentioned NBFC, so let me try and squeeze in that question there. What specifically changes for NBFCs from a tax standpoint, and what would be the impact?
Okay, so if especially the foreign-owned NBFCs, they would generally rely upon overseas borrowings from the shareholders or the related parties, and whenever they paid interest, there was a limit of deduction that they could claim on account of interest payment, which was 30% of their earnings. Now that caused a lot of problems for NBFCs to actually borrow funds from their foreign shareholders or the related parties overseas. That a limitation has been now done away with for a specified class of NBFCs, and we suspect that it will be all systemically important NBFCs which will get classified there. So essentially, what it means for the NBFCs is that they can actually now access the borrowings from their shareholders or associated parties.
Okay, so that's good news. Then it's always good to end on good news, right? Which is what brings me back to IFSC as well. Dipesh, so let's end with sort of more forward-looking vision questions, right? With the changes that you outlined, that you spoke of, do you really see the IFSC taking off in a big way? I know we're all waiting for the bullet train to leave BKC in Bombay and reach GIFT City quickly. But, on a more serious note, what lies ahead, let's say over the next 2 to 3 years?
Very well said, Surbi. I think we really see this as a transformation in terms of how the International Financial Services Center is going to roll out. We already have seen tremendous traction with more than 400 firms already in the IFFC zone. But with this new announcements coming in, we clearly see that that's a roadmap being laid down. And in next 5 years, if you really ask me, I would really definitely put my neck out and say that this is going to be a transformation of the International Financial Services Center from a global business perspective. And you will see a lot of institutions, not only from India, but from global centers coming into the IFFC zone to structure the international financial services business and scale up to a level that really the IFFC in India will make its presence felt in the global financial world.
Okay, well, that's an optimistic note to wind up this conversation on. Gentlemen, thank you very much for joining in and helping us decode the budget and go through the fine print and understand what really this budget has meant for the BFSI sector. Thank you very much for watching.
KPMG and CNBC-TV18 present Budget 2023, the fine print. Focus, ideate, innovate, enable.